Hey, it's Chris Rowe at True Market Insiders. I've got a quick heads up for you. This is a 20-year chart, and it basically is saying that we're near a bottom in the stock market. I'm not saying it's the bottom, and actually looks like potentially we can go a little bit lower, but I think it'll probably be quick and rebound fast. So this is the Investors Intelligence Advisors Sentiment Index. On the top is the S&P 500. On the bottom is the Advisor Sentiment Index. It's one form of it, long story short. When the blue line at the bottom is at a low, it's extreme pessimism, extreme bearishness. And it's actually a contrary indicator because when people are overly bearish and when too many people are bearish to think the market's going to go lower, it's called a crowded trade and it reverses higher. And you could just look at the history of this and see that throughout history, whenever we got down to this zero level and below, it coincided with a major market bottom. So you can see the 2022 June and October low coincides with this. Here's the COVID crash low. Here's the 2018 low, which is very similar to now. Trump was tough with trade on China with tariffs, and there was a looming government shutdown as the market came down, and there was a government shutdown after that. So that was kind of the selling climax. Then you have 2015 and 16, October, January, where the market double bottomed, went to a big bull market. 2011, when S&P downgraded the U.S. Credit rating for the first time ever, and 2010 flash crash. Now this is a 20-year chart, and it's arithmetic and not logarithmic, which means that it moves higher in absolute price, not in percentage. So what that does to the older data is it makes it look like it's not a very big jump, and up here it becomes much more volatile. But the point is that if you look at the flash crash, it was a scary time. 2011, very scary time. It just doesn't look like it here. It looks like a little blip. It's 20 years of data. And of course, here's 2008. And all these times we got below zero. 2008 was a much bigger deal than what we're going through right now. The closest comparison is 2018, as I mentioned, the tariffs on China, government shutdown. We squared away the government shutdown already, so it's already out of the picture. I'm going to show you one thing here. Hold on a second. Here's a 20-year chart of the S&P 500 on a logarithmic chart, not an arithmetic chart. So you'll see that those declines that I pointed out are much more pronounced. So here's the 2008 decline, big volatility. And we got the 2008 low. So here's the 2008 sell-off, which really shows up on this. But I mean, to give you an idea, look, this is a 2008 crash right here. Doesn't really show up. But here you can see it's a big decline. 2010 flash crash right here, that little tiny blip. When you look at it on a logarithmic chart, you can see it's a big decline. It's 1219 on the S&P down to 999. It's like, what is that, like a 17% jump? This is a 19% sell-off. These are big dips. This is 15% sell-off in 2015. So point being, anytime we are down here, we're at or near a bottom. 2008 was a little different. I don't think it's 2008. So getting back to today's market, let's just look at a daily chart, 6-month daily. Actually, let's go to SPY because SPY will show you volume. And if you look at the price volume activity, it actually looks like the market could come down a little bit more. But whenever markets are in this condition, what we say and what pretty much always happens is either this is the low or we are close to a low and basically the floor can drop out and then you rally right back up. So to give you an idea, that happened in 2018. We said that right here, and of course the market dropped, ran back up. Then in 2020 with the flash crash, we said the same thing right here, dropped, rallied back up. And then there were other major lows where I said that. I said either this is the bottom or quick drop with recovery swiftly. I'm seeing big volume selling here. It does not look, it looks like the market wants to drop a little bit more. But don't panic. That's the key point here. Do not panic because look at where the Advisor Sentiment Index is. People get very emotional. They see their account drop. They make quick decisions. It's not a good idea to do that. You always look in hindsight and regret it. So yeah, it would have been nice to have sold and avoid the volatility to come. Like what if there is more downside? But what if there isn't, right? So you don't want to sell here and just take solace knowing that if we drop, probably going to rally right back up very, very quickly. All right, this is Chris Rowe, True Market Insiders.